Joining us on the show right now is a very special guest, and let me welcome Rob Subbaraman, who is the head of global macro research at Nomura, from the sidelines of their investment Forum Asia meet that is underway, and we'll try to understand from him how the global macros forces are shaping the market expectation from US inflation stickiness to the shifting landscape in Asia. Rob, great to have you with us on the show. Thank you so much for your time. And
great to be here.
Firstly, great to have you on the show, Rob. But firstly, let me start with the US market expectations, because with all the tariff announcements, one cannot rule out that the tariff-related uncertainty can impact the inflation going forward. The business environment is uncertain. But help us understand, Rob, what is there that lies ahead for the market? What, as per you, is the biggest pivot risk for the market, and how do you sense that, and how do you see the factors shaping up?
I think for the US market, the biggest pivot risk is that the market starts to wake up to the fact that tariffs are going to be inflationary. I think right now the focus is on tariffs and all the uncertainty leading to softer growth in the US. And there's an assumption that lower growth means lower inflation. But we think it's different this time because the tariffs is like a negative supply shock. It's like a tax on US imports, and we think it's going to be stagflationary. So I think the wake-up call for markets, which is increasingly, I think with the data in the US this week, starting to price in more Fed cuts, I think the market wake-up call is actually the US hasn't got complete control over inflation yet. It's still way above its target, and it's picking up again in the coming months. And so the Fed cannot cut rates as quick as the market hopes. The Nomura view is that the Fed is not able to cut rates until December.
All right. Yes, I believe, Rob, that you are working with the 25 bips of cut, but just to happen in December. But along with that, Rob, give us a sense on the emerging market as well, because of late, if we see the start of January, and especially after US President Donald Trump made his victory, there was a strengthening of the dollar index that we have seen, which was definitely not boding up well for the emerging market. But now that when we see the cool off happening, and then there's uncertain environment in the US, do you believe that once again there's a case where the emerging market starts to appear a bit attractive, and how do you see the macros shaping up?
So I think emerging markets actually is going to be extremely mixed in the second half of this year. There's typically investors have this perception, especially those that are from the developed markets. They assume that all emerging markets are a homogeneous group and they kind of move in sync. They all cut rates together, they raise rates together, currencies depreciate, appreciate together. But we think it's going to be very different in the second half of the year because there's many different cross currents affecting emerging markets, and they affect some economies differently to others. So we have the tariffs and trade deals. So we do feel India will probably get a trade deal with the US. Many emerging markets won't. There's also the overcapacity from China that's bringing exporting disinflation to EM. There's lower oil prices. There's currency appreciation in some countries, like in Northeast Asia. And there's the AI theme that remains very strong in our view for chip exporters. So my bottom line is that it's going to be very mixed. There's going to be some leaders and there's going to be some laggards in emerging markets. And in the Asia region for emerging markets, we would say some of the leaders are India, Taiwan, and Malaysia.
India, Taiwan and Malaysia, those are the preferred pockets. But give us some more sense on Indian markets specifically, Rob, given the fact that we are amidst the rate cut cycle. Markets are also hoping for one coming tomorrow, and more in the times ahead as well. And along with that, the inflation seems to be cooling off. The earnings season so far hasn't been that disappointing, but other than that, the markets are not working with a very good numbers on the upcoming earnings. How attractive is India when it comes to be an investment destination? How do you see the macros for India?
I think India remains and is going to be increasingly a very attractive destination for foreign investors. And when I say foreign investors, I mean foreign direct investment. That's companies investing in India, but also portfolio investments into India. So look, Q1 GDP growth was exceptionally strong in India, 7.4%. It's going to definitely moderate from there. That's extremely strong. Our forecast for this financial year, 26, is 6.2%. And just to put that in perspective, 6.2% compares with our forecast of 4.5% for China, around 2% or less for many of the advanced economies. And the global growth is going to be under 3%. So India is going to be growing twice as fast as the world economy. And the added benefit for India, we think, is inflation is well and truly back in the bottle. Our forecast for FY26 inflation in India, CPI, is 3.3%, below the RBI's 4% mid-year target. We reckon tomorrow RBI is not only going to cut interest rates by 25%, it's also going to lower its inflation forecast for this FY26. So we're very positive on India.
That's so good to hear, Rob, that you're very, very positive on India and how do you see the macro shaping up. But help us with your take on China as well, because amongst the two giants, US and China, they did try to crack a deal on the tariff front, but yet again, China did remain to be a bit of an attractive destination for the investors. Back then, we have seen the flows to be very strong in the second half of the
Mm.
last fiscal. But with respect to what's really been shaping up in terms of the tariff, how do you see the fund flow for China and its economy growing?
Well, look, we do see continued strategic rivalry between the two great superpowers, US and China, and we think US tariffs and trade restrictions, particularly around tech, is going to remain. The thing about China, in our view, is that a lot of the growth that we're seeing now in China that's been helping the markets in China has been front loaded. So because of the anticipation of tariffs, there's been a front loading of production and exports. The trade-in program, where in China, to try to get consumption going, the government is subsidizing if consumers, households trade in their durable fridges or TVs, cars for new models. Um, you can only buy so many fridges every year. So we think for exports and consumption, it's front loaded and there's going to be payback with weaker exports, weaker consumption in the second half of the year. So, second half of the year for us, for China, we have around 4% growth. And so that is going to be a bit of a weight on China. If I bring it back to comparison to India, an interesting fact is this year, if you look at the not Nomura, but even the IMF forecast for GDP, just the dollar amount value of GDP, size of the economy, 2025, India is overtaking Japan to become the fourth largest economy in the world at $4.2 trillion. And if it keeps compounding growth of around 6% real, maybe 3% or so inflation, that's very fast, nearly double-digit growth, nominal. By 2028, we think India will overtake Germany and become the third largest economy in the world at around $5.5 trillion. That's really important because India's economy is getting to the size, the critical mass, where it's getting recognized by global investors. They have to be part of that India market that attracts FDI, and on following that is the portfolio investment. So, relative to China and many other emerging markets, we do think India is going to stand out in the coming years.
That's so good to hear, Rob. And yes, indeed, that also instill us and give us some sense of pride when we get to hear that, yes, we are going to be the fourth largest economy and maybe the third in times ahead. But the
Mm.
clear-cut verdict, Rob, is that between India and China, if you have to choose one, you will go with India?
I think if over a longer term perspective, in terms of when you go for India, I guess it depends what you mean by go for India. But if I was to rephrase that question in terms of in terms of the sustainable growth and who's going to have higher sustainable growth in the next 3, 4, 5 years, I would definitely be putting my eggs in the India basket for that.
All right, Rob, with this, we let you go on. That's so good having you on the channel today. Thank you so much for taking the time out and speaking with us.
Thanks for having me. Take care.